think tank that conducts research and works around informing policy debates. So at the IEA, we've been conducting a series of webinars. This is our webinar, I think it's the 32nd webinar. And we have been just discussing the different impacts COVID-19 has had on the different sectors across the globe and in our country. And this morning we want to discuss, of course, the impact it has had on the real estate and what that means for the future of the same. And of course, we are aware that the pandemic began as a health crisis, but it then trickled down and affected every other sector. And therefore, we felt it is important that we also have discussions around these sectors. We have had discussions about the health sector, but as we slowly continued with these discussions, we realized that, yes, it was affecting all the other sectors. So this morning, of course, we have a distinguished panel of experts who are going to break down some of the issues that we wanted to have discussed this morning. And in my panel, I have Jacob Osoro, who is the Director for Credit Markets, FSD Africa. Sorry, Jared Osoro. And then we have Elizabeth.
Something on the future of real estate, done by
Jonah, please mute your microphone, and we request everyone else to please remember to mute your microphones. And then we also have Elizabeth Nkuku, who is the Chief Investment Officer from Saiton Investments. And then we have Ms. Sakina Hassanali, who is the Head of Development Consulting and Research at Has Consult. So, of course, when we're discussing issues about the real estate, we are aware that according to the Economic Survey for 2020, the year 2019 saw a growth in the sector by 5.3% from the 4.1% in the previous year. So that indicates that possibly the sector was going to see another growth in 2020 if it were not for this pandemic, and that will be made clear to us by our panelists. And then again, in the first quarter of this year, the sector experienced average activities, resulting in average investment returns. Of course, the average investment returns also saw marginal improvements in the residential and commercial offices in Kenya. So for the residential sector, they recorded a 0.2% improvement and a 0.3% for the commercial offices. But now when you look at the retail sector, and we noticed that they had a drop of 0.1% in the rate of investment returns from 7.8% in the last quarter of 2019. So we want to understand whether the decline that we've seen in the first quarter of this year can be attributed to the pandemic. And in as much as the pandemic, we started experience so much of it in March, we just want to understand if we can attribute some of this low growth that we saw in the first quarter for the real estate, if we can attribute it to, of course, the pandemic that we're experiencing. So we have Jared Osoro, who is going to break down to us, of course, the housing pricing index. We're aware that this is a tool that provides market players and policy makers with information that allows them to track the housing sector on different variables. And the variables we are discussing, we have location, we have quantitative characteristics, and of course qualitative characteristics. And Jared will be breaking that to us. And then we'll have Ms. Elizabeth and of course Ms. Sakina come in to break down to us in terms of the impacts that we have had for both the demand and the supply side. And we'll be looking at both the residential and the commercial spaces. spaces. And when you're looking at the commercial spaces, we will be looking at, we have, of course, office spaces, we have retail where we'll be looking at shops, we will be looking at the hospitality sector and the construction sector. So these are some of the things that we want to discuss, and we are aware that at Has Consult, they also have a housing index, which Ms. Sakina will be breaking to us, and we know that they have for Q1 and Q2 for this year, and they'll be explaining to us what are some of the lessons that have been picked based on the indexes that they have carried out, and what these definitely mean for the future of real estate. So please, I'll remind us that we will keep our microphones on mute and our cameras off as the presenters will be making their presentation, and please make use of the chat box icon that we have. So as the presenters will be making their presentations, should we be having any questions, please feel free to type in that question, and the presenters will be looking at them, and then they will be responding to them during the plenary session. So without taking much of time to do this introduction, I want to now invite our experts to dig deeper into the introduction that I have given, and we will start with Jared Osoro, who is going to break down the housing price index to us and help us understand how much goes into building that index, and what, based on that index, this pandemic means for the future of real estate. So Jared, karibu, you have 15 minutes. Thank you. Jared? Jared, you're still muted. Oh, he had to leave and rejoin.
Is everybody able to hear me now?
Yes, Jared, please go ahead. We can hear you.
Are you able to see my slides?
No, we are not.
Okay, so then let me just load them up so that and now?
Yes, we can. Please
Okay.
put the full view.
Okay, yeah, that's fine. I'll do exactly that. Sorry about that. The technology usually works, and then when you... So thank you very much, Winnie, for the invitation, and thanks for the Institute of Economic Affairs for organizing this very important forum. I think you touched quite a number of interesting issues in your introduction about the broad dynamics that happened in the real estate in the period before COVID. My presentation will be very brief, and it will touch on two aspects, really. The housing component and the index that tracks the movement in houses. Speaking to the nitty-gritties and mechanics of the index, not necessarily in a very technical way, but in a way of trying to illustrate what goes into that index. And then from there, we try to distill what it means in the period prior, during, and even the period post-COVID, insofar as the demand and supply dynamics are concerned. Cognizant of the fact that, the index is just one of the parameters for tracking what's going on. There are other broader issues, including the dynamics around the market itself, the policy environment, other interventions, and how that fits into the broader economic framework insofar as the real estate is concerned. Now, I think to step back, it's important for us to really know why it's important for one to have an accurate measure of house prices. There's a gentleman called Steven Novella, interesting a neurologist, who says that anecdotes generate questions, but they not necessarily give you answers. And when it comes to housing, we see a lot of anecdotes and critical inferences being made out of anecdotes. For those who watch the conversation around housing in Kenya, you must have heard for a very long time people talking about we're likely to have a bubble, it's bursting, we're actually approaching it. And usually that is not really based on any scientific measure. And that's why it's important if you have an accurate tool, such as an housing price index, then it gives you a chance to be able to know exactly what you're confronted with. And that is why it's important for us to understand what that index constitutes and how it plays out in the space. But beyond that, I think it's important to appreciate that housing has the two dimensions of it being a social investment as well as being a commercial and economic investment. Therefore, a good and reliable index enables you to be able to actually look at the performance of that asset class vis-a-vis what alternative investments you could be having, be it in fixed income or equities or other investments. And therefore, a good index basically gives you a gauge as to how the performance of the sector is concerned. The other is really to appreciate the fact that, to the extent that, housing is substantially funded by the financial system, there's a lot of sophistication that is really accompanying the deepening of the financial system. And therefore, with that sophistication, if there is a link to the housing sector, then it will be nice to appreciate how that sophistication is underpacked by each of the performance of the sector, and therefore enabling how it's growing. But beyond that, what are that growth as dimensions of instability. And the final one, in terms of really why we need an index, is to appreciate the fact that sometimes some of the numbers, like those that Winnie highlighted, of course, give you a flavor of how the sector is performing, but they come at a very, very low frequency. If you're going to rely on the annual survey, the economic survey, which comes annually, you probably be relying on 2019 numbers for you to take a view of what's going on in 2020. So an index that comes on a higher frequency, and many of them come on a frequency of a quarterly, essentially gives you what you can call the leading indicators insofar as you're appreciating how the housing sector performs. So when you see indices, most notably the one that is framed by the Kenya Bank Association coming out on a quarterly basis, the idea is to really give you a much more frequent leading indicators that can allow you then to be able to either use that to measure the growth, or use that as a way of really looking at whether the returns that you're getting compare with other investment opportunities that you could be having if you take housing and real estate as an investment of a commercial nature. Now, and I'm not going to really be very mechanical here, but just to indicate that, housing price indices are special in the sense that they consider the unique attributes of houses. We are all too familiar with the typical indices that are used, for instance, to measure the consumer price index. The last payers index is one of the common one, and I think is the one that is used for measuring the consumer price index, where you have a basket of goods, and you look at how the price of that basket is right now compared to a base period. The other one that is common but not frequently used is the purchase index, which basically looks at how a given basket of goods, what it costs now vis-a-vis what it could have costed at the base period. And these two may not be suitable for housing, simply because in that basket, the goods that are there are basically homogeneous. A house is not a homogeneous product, and therefore there are specific things that are unique to houses that you may need to take into account in your measurement of the evolution of prices. And that is why things like location, the finishings, the amenities, the social, the neighborhood, and all those other aspects, which contribute substantially to the price of a house, needs to be taken on board. as well as the quantitative aspects, including, for instance, the plinth area of a house. So the hedonic model is really what could be classified as a workhorse insofar as the measurement of the housing price is concerned. And if you can be able to see on the screen, what I've displayed there is what you can call the hedonic function, which you input all those parameters, and then you are able to use that as a basis for computing your index, taking into account time variables, as well as the quantitative and qualitative parameters. And then that gives you a flavor now of why a house of a certain characteristic in a certain neighborhood is costing a certain price, compared to a house in a different neighborhood with different characteristics. But the one thing to note is that an index does not give you the price of an individual house. An index simply is a statistical tool that enables you to be able to see the movement in house prices generally. And because of things such as location and those characteristics, you can have the sub-indices now that classify houses in different layers, low income, middle income, and high income. And depending on which locality it is, then you should be able to know which specific component or segment you're going to look at for purposes of investment. So that's really how the housing price index is constructed. Even though we don't have really an index, at least to my knowledge, that measures commercial property. I think what we have for housing could be a very good proxy for what's happening in the real estate, and therefore the inferences that you can make from there, even though the dynamics may be different, could actually give you a good flavor of what's going on in the real estate generally. Now, the index that I'll make reference to insofar as evolution is concerned is the Kenya Bank Association Housing Price Index, which goes through the technicalities of an hedonic function, which then you estimate using econometric parameters, and then you compute an index out of it. The index has a base period of 2013, and it's computed on a quarterly basis. The last that has been published is the second quarter of 2020. And I think that gives you now a good trend for you to see how the housing prices has been behaving. If you look at the chart, the graph on your left, you'll probably be seeing how the index, which was at the base of 100 in the first quarter of 2013, has been evolving. And you could see that in those initial period, the prices have been on a steady rise, gradual but steady, up to some point around the third quarter of 2018, when we started seeing the index reversing. And if you want to see how that behaves in terms of the percentage change in prices, you could actually see that when they started reversing, the prices moved quickly from being positive but gradual on a quarterly basis to actually being negative from March of 2019 and 2020. Therefore, if you have to start having a feel of what COVID has impacted on housing, then the one thing that you can take away from this index is that the softening of the house prices actually started happening even before COVID. And I'll give a few pointers as to why that was the case, and why now whatever you're seeing has actually been exacerbated by the COVID environment. So this is essentially how the index evolved. The other thing to note is that now that we are on the negative, it's not that the prices have been going up on a quarter-by-quarter basis. What has been happening is that in the initial period, as the index actually illustrates, whenever the prices actually dip, they tend to correct in more or less the subsequent quarter. Now, as an indication that no, things are now fundamentally different, and the dynamics have really moved to a situation where the housing market is experiencing challenges, is that we don't see a drastic correction now that the prices are on the negative territory. So that is really the background around which now you can start reflecting on what COVID means insofar as pricing of houses is concerned. Now, and this is something that I think Winnie mentioned. I think COVID affected all segments of the economy almost in equal measure. So, as you well know, real estate is really part of that ecosystem, and therefore it has really been affected. And as I've mentioned, on the basis of the index, what we can call the initial condition was that, at the point that COVID was coming on to hit us as a shock, we had already started seeing the softening of house prices. And this was as a result of the fact that, on the one hand, there were dynamics in the credit markets that affected both the supply and demand side of the housing. But also we had started seeing a situation where the market segmentation was in such a way that the areas where there is more supply, probably there was weakening demand, and where there is abundance of shortage, I think we didn't see supply being aligned with that. So that is really one of the things that were happening even before we had COVID. Then we also started seeing what you can call leading indicators that align to the softening of the housing of the housing prices and the construction industry generally. You started seeing players in the steel and cement manufacturing actually experiencing challenges. I mean, see big cement manufacturers that are considered blue chip giving profit warnings, and that tells you that there are probably some fundamental challenges that are happening in the sector even before we had COVID. Then now we started seeing that there's a sense of those who are already locked in, either on the demand side or on the supply side, trying to take a positive posture insofar as what's happening in the market is concerned. But I think that notwithstanding, what was evident was that the weaknesses started revealing themselves, and one of the ways in which they started revealing themselves that in the event that assets are financed by the banking system, then we start seeing the quality of those assets deteriorating. That's actually the way in which this was revealed in the market. Now come COVID, and then you start seeing now a reactionary or defensive reaction by market players, where on the first order you see the financials actually scaling back because of the softening that they already started seeing, which, as I said, has revealed itself in the quality of the portfolio that they are holding, deteriorating over time. And then because of that, investors also had to inevitably scale down because of perhaps limited opportunity as a result of the weakness in demand, as well as limited supply of funding, now that the defensive reaction of the financial is ready to scale back on the funding. And then on the broader level, we started seeing, all these responses in terms of stimulus, either an accommodative monetary policy coming on board, allowing for the lenders, for instance, to give a moratorium. But the fact that that was not very targeted simply means that we've not seen that filtering into affecting the sector in a very positive way. And of course, like many economies, you could have started seeing some fiscal interventions, but unfortunately, the initial conditions from insofar as the fiscal side is concerned were unfavorable. So the broader macro dynamics could be argued to be in the right direction, but I think the fact that they lack that specificity of targeting didn't help address some of the weaknesses that can be seen when you track the market. So out of that, I think one can make some key highlights insofar as the market is concerned. And one is to say that the market segmentation or skewness is actually more evident, especially now that we've seen that softening being fundamentally affected in a negative way by COVID. So one is to say that there's a sense of more supply on the upper end than demand that can match, because we started seeing investors incentivized to invest more on the upper end, simply because they see opportunity. But I think the softening in prices that has been tracked, for instance, by the KBHPS, have already highlighted, point to this fact. The second is that the middle, where you talk about the upper and lower middle, has actually been disrupted because if you see a pandemic that has actually affected the effective demand, meaning the incomes of individuals, then I think this feeds into the opportunities that could be either arising out of that segment being vibrant, and therefore being able to afford a house. So this is actually now where you started seeing the effect of COVID coming through. On the lower hand, I think there's been a lot of discussion around affordable or social housing. And I think to me now, given what we have seen, this requires quite a bit of a careful balancing act because on the one hand, there's a public good angle, meaning that for you to really move affordable or social, you have to provide some requisite infrastructure that then can allow investors to to intervene on the supply side. Of course, assuming that you put into the market units that are affordable. But that's really on the social housing or what they're calling affordable housing. I think the commercial angle here is that if you have to look at the provision of the public goods, of course, on the back of the limitations of the physical space, then you have to start seeing to what extent will you address this lower component on a pure commercial angle. And then you address the aspect of affordability, because unless you have that blend of public good and commercial intervention, then I think affordability will be what will be compromised here. So that's really how I see the dynamics, of course, backed by what we have seen in the index, as I've illustrated in my presentation. Thank you very much. Back to you, Winnie.
Thank you so much, Jared, for if you don't mind, we can stop sharing.
Yes.
Yeah, so thank you so much, Jared, for breaking down to us the housing price index and how we can look at it in the wake of this pandemic, and what some of the data presented in those reports mean even for the future of the real estate, and of course even as we welcome now the people who are in the sector, the players in the sector, like we have Saiton and Haas, to now break down to us what is exactly happening from their end. We appreciate the fact that now moving this conversation forward, we are able to understand what the housing price index really is about and what actually goes into it in terms of the calculations done to ensure that we have the right quality in terms of the three variables that are considered. So I'll move forward to welcome Ms. Elizabeth. Elizabeth is the Chief Investment Officer at Saiton Investments, and she's going to speak to us from both the demand side and the supply side, but looking at residential and commercial spaces. And like I had indicated, will be for the commercial, we have the office spaces, the retail shops, and hospitality and construction sectors. And of course, with the residential, we already know what has been going on in terms of the conversations tenants have been having with their landlords. And I believe this has extended even on the commercial. And with the new normal of having people working from home, what does that mean for the future of even commercial spaces? Will we see people reducing the space, their commercial spaces for the offices? Because there has been that conversation going on of once we adjust to this new normal, people might now continue with it even to the future. But now Elizabeth will come in and give us clarity on that. And should we continue with this into the future of having people working in shifts and having people working from home, what then that would mean for the real estate sector, especially on the commercial side. So Ms. Elizabeth, karibu sana.
Thank you, Winnie. I'm not sure whether you can see my presentation.
Yes, we can see it, but do you mind sharing the full view?
Try and see how to do that. How do I do that? Is it okay now? Not yet.
Not yet. If you go, do you want me to share from my end?
Yes, you can, please. I've stopped sharing.
All right.
Okay, you can go to the top, and thanks so much.
Maybe discuss what we are seeing on the real estate side from our end. When did this be brief?
For maybe discuss what's on the real side, the real economy, and what we have actually seen from the various sectors. So if you can just the next slide. Sorry, I should be able to do. So a quick overview in line with what is happening in the GDP sector. You can actually see this year the focus is about 2.3% growth in the total GDP, and this is in line with what maybe if you look at what the Treasury said. They're actually looking at 2.3, but our own projection is that we might end up being much lower than this. But I think of interest is the fact that this month, the month of September, there was significant recovery, so which is going to actually seep through to the to all the sectors. So just looking at the next slide, where we are looking at the trend analysis of how real estate has performed over the last years. So a lot of growth in the real estate sector, so growing at about 4.3%, about 5%. So real estate cannot be ignored if you are to set up, if you're going to help the economy to grow or to get out of where it is. So the importance of real estate remains quite high, as can be seen in the other slide, the next slide, whereby about 8.3% of the GDP is actually coming from contributors to the general performance of the sector. So that's why I think this webinar is also very timely for us to see what is it that is happening in the real estate sector, what is its contribution, and what is it that we are saying going forward that is going to help move the real estate sector. So on the next slide, what I have decided to do is just to look at trend analysis of the performance of the various subsectors within the real estate. On the residential side, for the year 2020, you can actually see, yes, the rents have not significantly come down. The rental yield remains at about 5%. However, the capital appreciation is what has taken a hit. I think there has been a slightly lower growth in capital appreciation. And as Osoro had said, you can actually see that the trend just didn't happen in 2020. The capital appreciation trend has actually been reducing. So from 2017, where the capital or the average was about 5.1%, reducing to about 4.2 in 2018 and about 2% in 2019. So this whatever we are seeing in terms of slowdown had actually started earlier. But one of the things to look out for, this is for the entire market. There are also some sub-markets that continues to do well, and especially areas around the satellite towns. I think that's one of the things maybe we shall be looking at when you look at maybe the Has Consult report. The next sector is actually the retail sector. Yes, has been also softening, and some of the reason why we saw a slight softening in the retail sector is because we have seen some of the anchor tenants maybe not being able to meet up their obligations. So things like where the Nakumat used to be have been slightly hit, but you can see there is no significant dip. This is because also the demographics still support and still support the demand for the retail space. So we have seen a slowdown, but not a complete collapse in the retail sector. If you look at what has been happening in the malls also, when maybe one of the tenants leave, if it's Tuskys, wherever they are living, you can actually see another supermarket actually taking up that space. So yes, there is a slight decline, but we don't expect to see significant collapse in the sector. On the office sector, I think this is one of the one that has been maybe significantly hit because of what has been happening. But the biggest issue that started well in 2019 has been the number, the space that has been available. There's so much space that has come into the market, and especially when you look at the office spaces along maybe Upper Hill, when you go to Westland, there's a lot of office space, and that has led to lower occupancies and slightly lower yields. So the yields are about an up of about 8.1. We are talking about 7% as we speak. Going forward, we could even see a slight decline again on that based on the occupancies. There's also people trying to consolidate their offices in line with the fact that also they might not get all that space as people work from home. So in totality, when you look at the office commercial space, the we actually think that unless you're coming up with really good grade A offices, you might actually see some slight decline in total returns there. So just looking at what was our outlook before COVID, and I'm just going to through a couple of those. On the residential side, we remained neutral, mainly due to the fact that despite the fact that some of the capital acquisitions were coming down, there's still a lot of demand. There's still a lot of pent-up demand for the residential, especially on the lower end of the curve. If you go to the completely high end, if you select your right locations, you still are able to actually exit and get good prices for that. For the commercial offices, due to the really oversupply of space, we were slightly negative, but again, looking at the quality of the office that you are bringing up. For the retail, we remain neutral. Hospitality initially was positive, was looking up, as Kenya remains as a regional hub, and that was picking up. But now it was one of the hardest hit sector due to the pandemic. But again, I think we are seeing some recovery there. On the land side, we were positive, especially for places outside the Nairobi metropolis. Infrastructure remains a key thing and a key driver of the land prices, so I'll combine the two of them. So if you are looking at a place like the Kiambu area, where there is a lot of roads coming in, the sewerage getting there, the land prices are still expected to go up, and also, as people also don't mind living slightly away from the CBD, but are able to get here. One of the places that has not really done well over time is the listed real estate, and it's basically because of they need a lot of more education. We need to see more products in the market so that people are able to actually have variety. So as we speak right now, we only have one listed G rate, but we are the result of efforts towards growing that. So in totality, when you look at the outlook for real estate before, was not as maybe as bullish as it was in 2018, but there was still a lot of hope in terms of how it's going to grow, and it's also partly because of the importance of real estate in the entire GDP. So just looking at maybe what are during the COVID period, what were the key things that happened, the immediate impact of that on the sector. There was the reduction of the labor force and disruption of supply chains, which led to longer development timelines. So if you're already, by the time if you're already on site and you needed to continue constructing, there was a lot of things that you needed to put up. So that again increased the timelines that were set out for people to complete their project. Then there was a slowdown in building approvals. As some of the offices like the City Hall were closed during that period, and also the Lands Office was also closed. Then they reduced construction activities, and also as people tried to conserve capital, you really didn't know how long this pandemic was going to go on. So the developers actually took a step back to just maybe first see how this goes. But again, for people who were actually doing their own development, so if I'm developing for my own self, then there was a lot of activity, and that can actually be deduced from the fact that the production of cement and consumption of cement actually went up during that period of time. Then for people who actually do off-plan purchases, there has been a lot of back and forth with the buyers, because some of them, the cash, their source of income has actually been slightly disrupted. But now we're actually seeing a lot of them coming back and being able to pay that. Then there was also significantly reduction in funding into the project. That's simply because even the banks were trying or are still trying to understand the credit scoring and the new environment. So in totality, there were a couple of challenges, but I think with the reopening of the economy, we're actually seeing things coming back to normal. So the next part is just looking at the effects of the pandemic on the real estate sector. So on the residential sector, yeah, the expectation is that the rents would be lower and the prices would be slightly lower. Also, the expectations are actually would have seen a significant tank, but that has not been the case. So if you look at what is happening, people are just downgrading maybe from slightly more expensive neighborhoods to less expensive neighborhoods, which is also good for the entire sector, because there is really no significant decline in price in rental income. For the office sector, they reduce occupancies and they reduce FDIs into the sector. So all this is actually affecting the office space. Maybe it's time to see how the serviced offices actually are going to do, especially as as businesses downgrade. Go to the next slide. Then on the retail sector, as I have said, shops are closing, but at the same time, we are seeing a lot of other people taking up spaces. I think that's what happened in the waterfall in Karen. That also, we just actually not seeing significant lags in terms of between when someone leaves and a retail space and when by the time you get another one. But I think the biggest issue that maybe will affect the retail sector will be as people embrace e-commerce more and more, so that might lead to less footfall into the malls. And maybe I think that will be the largest threat to that. And if that takes off, then the warehousing, industrial, maybe is what is going to benefit largely from that. For the hospitality, what happened was the closure of major hotels, but we are seeing one by one actually people reopening. There were significant layoffs from that sector. But again, with the recovery and the travel advisory coming off, I think we should be able to see some recovery in that sector. Winnie, you can go. So for construction, whatever is happening in the construction, I think the supply chains, that again is recovering. There was a significant issue, especially given that we are a net importer when it comes to construction materials, but that has recovered. But the hit on the currency, where you're talking about a 7%, 8% depreciation in the shilling, then makes it more expensive. So those are some of the things that maybe will have to be passed on to the end buyer. Then lack of project financing. So we are actually seeing people being more innovative in terms of how they are going to get their capital. Then reduction of the labor force. I think that has actually been set out. So in totality, when you look at what is happening in the construction sector, I think things have actually normalized quite a bit over the time. So in terms of conclusion and going forward, I think the themes that are driving real estate remains intact, and some of the themes that we still think are going to do well over time are actually settled in this slide. So with the housing deficit remains high. So people are still, for people who are in the residential sector, there's still room for, there's still a lot of demand as long as it's at the right price point. So we are seeing the government really coming up to push, just pushing how affordability. So with KMR, with the mortgage company, that once it takes off, then that will be a big game changer. Then the growing middle class, I think, despite the fact that most of the people who would call at the floating middle class, they have actually now gone back maybe to the lower end. But I think there is, with the economy recovering, we could still see a lot of those people actually coming back to the middle class and being able to actually afford the sort of housing that they had before. Then the demographics, we are still a very young population. So depending on what you're investing in, you'll actually get a lot of people buying into this. So one of the things that maybe the current demographics would support would be largely the mixed use, commercial, and the master plan. So people want to live closer to where they can actually, where they are working and where they can have their shopping and everything. So the demographics, as we see, are actually going to support a lot of mixed use, high density investments. Then the infrastructure, I think, despite everything, we are seeing a lot of emphasis by the government in investing in infrastructure. The counties will be a big thing. And also, despite what is happening right now, I think Kenya remains at a very strategic point in terms of investments. And so that will continue supporting the investment in the real estate. So in terms of the sectors that or the themes that we see that are going to do well, anyone who is investing in master planned communities, mixed-use development, and the focus on residential will be one of the key drivers going forward. So in conclusion, we could say that one of the things that will determine how we get out of the pandemic is it is how long this how it is going to be. I think right now the biggest issue will be whether there's going to be a second wave of the pandemic. I think now we are wiser, so even if it stays for so long, it may not have as significant impact as it had before. We are more prepared now. So there will be some slight slow recovery, but again, given the fact that there was also not significant dips, the sector is still pretty supported. So we remained pretty really neutral. Given that's what I've gone through, what supports the real estate sector. So in summary, the performance is okay. The demand is still there. There will be some slight shocks here and there, but I feel like or just looking at the data, the sector remains well-footed to grow even going forward. Back to you, Winnie.
All right, thank you so much, Elizabeth, for for that presentation. It is good to note that even amidst the issues and how the sector has been affected, there is still some positivity, and you are clearly assuring us that things are not as bad as we may think, and there is certainly room for some level of growth. So initially, when I was coming into this, I expected to be told, well, things are not as good as they may look. But coming from you, the expert, it is very clear that, yeah, with the normalcy coming back, with the borders being open, with the flights are already back, and so it's clearly things are going back to normal, and that normalcy will also be experienced from the real estate part. And I mean, that's very encouraging, because out of all these webinars that we have been having, the main thing that we have been trying to encourage is to embrace the new normal and to see how we can pick the challenges and turn them into opportunities. And clearly from your presentation, there's we are, all is not lost for the real estate sector, and even the things that were not where they should have been are slowly coming back to normal. And probably we hope that with the next report, we might see a difference when we'll be presenting the next quarter's report for the real estate. We hope that we will see a difference, and we will see that yes, with the opening, even with the opening of the economy, even the real estate sector has some good things coming in. So we'll move to hear from Ms. Sakina Hassan Ali from Haas Consult, and she will be speaking to us about the Haas Price Index, and try to bring us to understand what their Q1 and Q2 report mean for the real estate sector, and how we can interpret them, and how the future of the real estate looks when we are looking at those reports. So Ms. Sakina, you have 15 minutes. Karibu.
Hi, Winnie. Thanks for having me. Are you able to hear me?
Sakina, unfortunately, we can't hear you quite clearly.
Okay. Just going to try that again. Are you able to hear me now, Winnie?
Better. And do you mind turning on your camera?
Its camera is on. Are you able to see me?
No, we can't, but you can just proceed. It's fine.
All right. So I think for us to really understand what's happening at the moment, it's important to just understand the nature of our real estate market, and to just understand the differences between Kenyan real estate market and some of the more international property markets that we normally follow. I know a lot of people have seen housing price crashes across the globe, And so this brings some sort of anxiety as to whether this is going to happen in Kenya. And I think Jared, in fact, he touched on this. And I think it best understood if you understand the nature of the market and to see whether this is possible or not. If you look at the Kenyan property market, it is very unleveraged. So what that means is majority of the people who buy houses buy it with equity and not with debt. That means they have the money and they're not going to the banks to borrow. And the reason for this is obviously at the moment we have our interest rates are quite high. And what this means is everyone who buys a house then owns it. Only 1% of people actually take debt from banks to buy houses, right? Now, internationally, 95% of the market that had housing crashes, 95% of them were debt-borne. So that means 95% of the people who had bought houses had taken a mortgage from the bank. So what happens is when you have a short-term economic shock, a lot of people lose their jobs. When they lose their jobs, they start defaulting on they default on their mortgages. The bank start to foreclose on those properties. Now, when millions of properties go back to the bank as foreclosures, the price of those houses is going to drop, right? In this market, what happens is when there's a short-term economic shock, even one as extreme as COVID, the people who have bought their houses are not going to, don't have monthly repayments to make in order to keep those houses. They already own them. So for the most part, they're going to sit and wait this out and look at selling the property later. You will have some hotspots of discounting if people have cash flow issues, but it's not going to be market-wide. And this is what we've seen. So if you look at our market, it has been I would say it grew exponentially from the year from 1995 all the way up to 2013. Now this high growth was very fueled by the almost complete lack of supply. And so anyone who builds anything would be able to find a market for it. As we reached, I would say 2016, 2017, and the supply of residential property increased, and some of the supply gaps were matched, we found that developers who weren't developing properties that were market aligned, that means they were not feeding demand markets that existed, were starting to struggle with sales. Now, I have to say that developers in this market got a little bit spoiled by the fact that off-plan selling was very easy back in the day. And that means that, if I wanted to build an apartment block of, say, 20 apartments, I'll be able to sell 15 to 18 pre-construction. Now, that means that your requirement for equity and debt is very low. As many developers, small-scale developers, hit the market, they were able to do very well. However, the excess supply in certain segments meant that some developers were not able to sell off-plan, and because they hadn't had a backup plan for equity or debt, then we saw their projects stalling, right? So from 2015 or so, we saw the market start to stabilize. So we had exponential growth from 1995 for about 20 years. And then we started to see prices sort of stabilize as supply started to match demand, especially in the areas where most developers were operating. And then what happened is with the interest rate cap a couple of years ago, we found that banks weren't lending, were reluctant to lend to anyone, which kind of swept liquidity from the market in general. Now that had a secondary effect on the real estate market in that, when there's reduced liquidity in the market, it causes a bit of an economic downturn. And when that happens, like every other sector, you're going to see a slowdown in real estate, which we saw in 2019. This was pre-COVID. In pre-COVID, we saw a lot of developers starting to have troubles, and these were developers who had probably not, I would say, the robustness of their financial planning wasn't there, and so they were very reliant on off-plan sales and hadn't thought about what their backup plans were for a market in which off-plan sales were not completely covering the construction of the project. So we saw a lot of small-scale developers drop off the market, and we saw large-scale developers have a more consolidated market share. When we had this global pandemic, what we saw was an absolute freeze in the market for at least 3 months, and I think that was from mid-Feb to mid-June. And this wasn't necessarily because of the economic issues. It was the unprecedentedness of the event. And so all investors, all developers, so from both sides, from the supply side and from the demand side, sort of froze on decisions just to see where this was going. Now, I have to say that the pandemic for us was actually a brilliant way for us to measure the robustness of the real estate market, because for the longest time, we know that the real estate market is actually quite stable because of the fact that it's highly unleveraged, and it's probably the safest investment class in Africa, due to the nature of it not being very debt driven. Now, a pandemic is a perfect way to really test the robustness of the real estate market. So for 3 months, we saw an absolute freeze. I would say there wasn't widespread price falls. Rather, there was hotspots of discounting for people, for developers who had not probably planned for a worst case scenario. You would find discounting there, and for people in the general market who are having cash flow issues, you would see discounting in the sale of their properties. After 3 months, we saw people sort of get into I feel like the pandemic situation kind of normalized a little bit, and people started to come back onto the market. Now, that was the short-term effect of there being a pandemic and no one knowing what it meant. There is a slightly longer-term effect of the fact that economic activity was frozen for a long time. Well, not for a long time, for about 3 months, and that had actual economic repercussions. So, the hospitality sector freezing, and a lot of people losing their jobs, that causes its own economic slowdown, and that will come back and affect the real estate market like any other sector. So what we saw is, for the people who were waiting to see what this would mean but were not really financially affected by the pandemic, those people came back onto the market. I have to say that for a large part, this was the high end of the market. We did see the middle market shrink somewhat. I feel like those are the people who probably were very reliant on wages, and they may have had salary cuts or some sort of retrenchment. So the middle market did slow down a bit. The high end continued to be stable. In terms of what happened to developers during this time, again, it was an even more sort of extreme test, more so than what happened last year in terms of our liquidity crunch. Any developer that did not have a robustness of financial planning would come under extreme pressure, and you would start to see the cracks at this point. I think we've seen a number of development companies have some trouble at the moment. So the one thing is, their financial planning, and the second thing was actually, were their properties market aligned? And I think this is probably the single most important development decisions that are made. It's not really how you're going to get it built, but it's what are you building, and is there a stable demand base for that? So developers who had robust financial planning and their properties were market aligned, I feel like they have retained their position and they have consolidated their market shares. And in a way, it has made our real estate sector a lot more robust. I feel like the strongest will survive. The people who've been the most astute in protecting the investors, the investor funds, the ones who have thought everything through. I feel like those are the ones that will remain, and it means that we will have a more robust real estate sector with only the strong ones surviving, and those are the ones who really thought through, how they were going to safeguard their investor funds. In terms of the HAS index, and I think I just want to touch a little bit on what Jared was saying initially, and he talked us through the results of the KBA index, and I feel like it's worth getting into this because the KBA index is a measure of actual transaction house prices. So as far as I know, I hope I'm correct, but it's prices that have actually sold at a certain rate. That's what the index is measuring. And the HAS index measures advertised prices. Now, the thing about transaction prices that is collected by the banks, unfortunately, I think the amount of data there may not be substantial, even though I would say it's more reflective because it's a transaction price. But the data set would be, I would think, would be a lot smaller than a data set of advertised prices. So if you look at the KBA index, it's actual transaction house prices, but a smaller data set. If you look at the HAS index, it is probably, I would say probably the data set is about 100 times bigger, but it is for advertised prices. So you're not going to be able to measure what the people actually closed on those prices for. So you're looking at what people are asking for as opposed to what they're actually getting. When we look at and I think this is it's a good indication of where the market is at. So when you look at what people are asking for, it normally will tell you what their expectations are and what their confidence level in the market is. Throughout this year, actually, funnily enough, we haven't had any major price falls in advertised pricing over the hundreds of thousands of records that we collect every quarter. In quarter 2, we only had a 0.2% drop in pricing across all properties in the market. And this quarter, I just received, they've not been published, I just received the results 2 days ago. And what we are seeing is an increase of pricing of 0.1%. Now, I think this kind of matches up with what Saitan was saying in terms of the capital appreciation has taken a bit of a hit, because a 0.1% increase in pricing is not great as far as an investor is concerned, but it shows incredible stability of this asset class even in the face of a pandemic. I would say that rentals, now this is actually a little bit interesting. I would say that, logically, that rentals are a bit less insulated to short-term economic shocks. And so that's across residential or commercial, because people have a monthly payment, and that might be affected by the state of their finances, whether they're in jobs or running a business, that might have been affected. So within HAS, so this is not part of the index, but within HAS, we found 50% of our tenants were asking for discounts of between 25 to 30%. Now, interestingly, and I'll be honest to you, when I received the results of the HAS lettings index, which is our rental index, so advertised rental prices, the rental prices actually have not changed, they've not gone down, which to me is a bit of a surprise. And it actually it's counterintuitive. So I would have expected, to be honest, I was completely expecting that rental prices, even advertised rental prices, would be going down. It seems like they haven't, so it seems like people are kind of holding the fort. What is actually happening in terms of what are people closing on rental prices is something that I don't have visibility on at the moment. So, just looking at these results that we received 2 days ago, I actually want to dig into the data a little bit and just try and understand this, because it's, to be honest, not something I was expecting. So I think that kind of shows the robustness of landlords and the confidence level of landlords in this market, in that they're not reducing their advertised prices. In fact, it's increasing ever so slightly. Which shows that these people are perhaps not under pressure, and this may be for a large part because their purchases are not leveraged, and so they own their properties and they want the rent that they want, and it seems like they're not going down on the advertised prices. So that's on rentals. In terms of the future of real estate, I have to say that what we are seeing within Has Consult may be not reflective of the entire market. Maybe I should just explain a little bit about, we may be seen as a real estate agency, but our core competence is development consulting. And what that means is every development that we take on, we look at the robustness of the financial planning of the developer. We look at their financial standing. We decide what kind of properties are going to be released onto the market. So we make sure that the properties are market aligned and they're meeting areas of high demand and low supply. So all that due diligence is very kind of strong for Has related developers, and so the sales of our developers have actually, apart from the first 3 months where we saw a freeze in everything market-wide, including our properties, we've seen our sales rebound. Now, this could be Has-related sales. I don't know if it's market-wide. I have heard some people are struggling out there. But in terms of, our personal experience here, it has the market has actually rebounded for us quite well. I do believe that because of our strength in ensuring that developments are delivered on time, as per quality, with a very little amount of risk, that's helped us in this time. So again, that's a skewed opinion. It's only related to the sales that we can see in-house at the moment. I would say in terms of the future of commercial and real estate and retail real estate, commercial was already sort of oversupplied, and I think being propelled into a new type of working environment for everyone has forced us to readjust how we work, and this may have an effect of stabilization, maybe even some falls in some areas, but I think long term we should be okay. On the residential part, again, in terms of the future of residential real estate, it's all about creating robust development houses that take care of investor interests and provide properties that are market aligned. I think that is the main thing. Anyone else at this moment in terms of in an economy that's facing a global pandemic, anyone who's had any inefficiencies in their planning, in their execution, is going to see it right now, and it's a good time to actually look into those and see how you can make your businesses a bit more robust, and use it as a bit of a lesson. So yeah, I think Winnie, that covers it from me, and I hope it's been useful.
All right, thank you so much, Sakina, for giving us your views and perspective for the future of the real estate post-COVID-19. And one thing that comes out is from both your presentation and that of Elizabeth of Saiton, is that there is some level of stability within the real estate. And for you guys, the reopening of the economy is also a very good thing, because with the reopening of the economy, as you have clearly stated, we are seeing the hospitality sector, the hospitality sector slowly taking shape, and that's a plus for the real estate when we're talking for the commercial hospitality sector, and also in terms of with the reopening of the economy, people who lost their jobs and probably had interest in real estate can slowly start settling in back into trying to get new jobs, and even those who had pay cuts companies are slowly starting to make a comeback and might actually sit back and relook the salary cuts that had been there. And of course, if people wanted to invest in the real estate, it will be a good moment for them. So in short, coming from the both of you, and of course from what Jared tried to explain, we understand that it's not what for me, it's not what I actually thought it was, because we thought probably you guys were really feeling the heat. But from your presentations, it's very evident that there is some level of stability, and things might be looking up for the real estate sector, even with the reopening of the economy. And we might be, as I had earlier indicated, be seeing some level of growth for the sector as we move ahead. So I think those are good things to hear, and as we continue the conversation and we move to the Q&A, I'd like to hear what the participants feel based on the presentations we have had. Maybe it could be a shocker, maybe it is what they expected to hear. So I will move to the Q&A session and just have listen to the participants and what they have to say. So a quick reminder, we have the chat box which you can use to post in your questions, and then we'll read it out to the presenters. And you can also use the hand raising icon on your screen, and you'll be given a chance to ask your question. So please feel free to continue to type in the questions you may be having for our panelists, and use the hand raising icon, and you'll be given an opportunity to ask your question. So I can see on the chat box you already have a question. And the question is for Jared. And Jared, Stephen Jairo is asking, on the issue of social housing and affordable housing, what is your view? Should the government do, what in your view should the government do to incentivize investors to plug in so as to meet the rising demand for such housing models? So Jared, you can have a go on that as we wait for the other participants to type in their questions.
Thank you, Steve. That's a very important question, because I think right now there's a focus on affordable housing being part of the Big Four agenda by government. I think when it comes to this segment of the market, there are three things that you have to have in mind. The first one being that there has to be scale. For it to work, you have to do it in scale. You can't have a few units being put in the market and you assume that it will suffice. Scale is important because and therefore that has to be borne in mind. And for you to have scale, you must have land. And land has actually increasingly been a huge input into the cost of housing, especially if it becomes very expensive. And that expense arising mainly from speculation around the fact that people assume land will continuously be appreciating. So whenever you see new infrastructure being opened up and new areas being opened up, which could be a good thing, if that is accompanied by a huge appreciation in the cost of land, then I think that will go towards making some of the units that are being put into the market probably unaffordable. So beyond scale and land, there has to be an appropriate financing structure. Because if you don't have sufficiently large amount of money, then it will be very difficult for you to provide that scale that I've already mentioned. So when you have those three things in mind, then you have to ask yourself, if the units have to be put in the market, and the market here means the targeted population that requires this affordable social housing, are you going to see affordability? And that speaks to another risk called offtake risk. And therefore, when you talk about social housing, you have to look at what component of that social housing provision need to be provided by government. And I think now that the issue should be around, should the government be providing land, if that land is available for purposes of development? Should the government be opening up new areas where there's land with some requisite infrastructure that then can incentivize commercial players to come and provide those resources that are required for scale? And then I think we have to start entertaining a conversation around whether necessarily providing social housing will require that, the people use them, need necessarily to own them. So a link between rental and ownership is a conversation that we need to have, because I think right now the conversation is almost exclusively being steered towards ownership of those houses, even when that may not necessarily be the appropriate model from the packaging standpoint. So that's really how I see that playing out insofar as that affordable housing is concerned. I think now that I'm speaking, I'll probably address one issue that Zakina raised, which was I think an interesting and accurate issue in the sense of what I said regarding the computation of indices. I think when it comes to indices, it's good to be as accurate as possible, and an index should of necessity be based by not necessarily the quantum of data that you have, but how representative that data is. So when you compare advertised prices vis-a-vis the prices of closed deals, the difference there is when you advertise, that's what you state. When you actually buy, that's what you reveal. And revealed prices are usually accurate than stated prices. But I think the bottom line is, if you can use still the advertised prices and you have a way of gauging that what's advertised is not fundamentally different from what is actually the price when the deal is concluded, then the indices should not fundamentally be different. It depends, therefore, on the mechanics of computation, whether you take them through the rigor of making sure that they're accurate. So that's really what I could say on that particular point. Thank you.
Thank you so much, Jared. I hope that answers you, Steve. And then we also have another question for you, Jared. Frida Kirera is asking, does KBA maintain a database of unsold houses? Secondly, what incentives can the government give to property developers to reduce the unsold houses? And then Rawlings asks, and all the panelists can have a go on this, can we estimate the proportion of foreign capital participation in local real estate? So we'll have Jared will respond to Frida, and then we'll have the three panelists have a go on responding to Rawlings.
Frida, unfortunately, I cannot speak on KBA. To my knowledge, KBA does not have that database of unsold houses. I think that information could be, for instance, with the Kenya Property Developers Association or something of that type of institution, but KBA does not have that information to my knowledge. On the issue of incentive, it depends on what kind of incentive you're talking about here. We've seen instances where the government has tried to provide tax incentives, for instance, for those who are developing houses beyond a certain threshold. Maybe you're developing 100 houses, you get some tax incentives. But it's one thing to have an incentive, it's quite another for you to actually meet the threshold of the conditions that are put under that condition. Point I'm trying to make here is that the biggest incentive for the government to give to actually develop property is to make sure there is streamlined processes in government. You have registries that are fast enough. You don't have bureaucracy, and you have also credibility in the process. That would be a better incentive than trying to give these other incentives that may be difficult to actually access. And beyond those streamlinings, and you could see progress when you track the government's ease of doing business strides, that there is an effort in that direction. Beyond that, I think is a case of trying to ensure that the government plays its due role in ensuring that we have a financial system that actually allows resources to be directed into housing as appropriate. When you have institutions such as KMRC being set up, I think you can see therefore the government trying to align its position towards making sure that housing is given priority. So that's really how I see the incentive issue being addressed. Thank you.
Thank you so much, Jared. So Elizabeth and Ms. Akina, if we can have a go at responding to Rawlings, who is asking if we can estimate the proportion of foreign capital participation in local real estate.
I think it's not easy for you to tell how much money goes to the real estate directly. So I've not seen data that I can be able to say this is how much that goes to real estate. So when data is reported, it's actually just it's not sector specific, unless I'm slightly wrong.
Edwin, please turn off your camera. Thank you. Hello, sorry, Edwin, do you mind turning off your camera? Thank you. Do we have anyone else with a question for our panelists? Feel free to type it, or you can use the hand raising icon and we'll give you an opportunity to ask your question.
Winnie, maybe if I can make a comment on that question around foreign capital participation in local real estate. I think whereas it may be difficult to actually put a finger on a number around the proportionality, it's a fact that there's an element of foreign capital that comes into the domestic real estate. And that this speaks to some of the issues that have been raised, the observation raised by both Sakina and my colleague from Saiton around the fact that sometimes you find a lot of development being done at the retail level, at household level. And if you look at some of the remittances that are coming into the economy, many of them actually end up in the real estate sector. So that is one component of external resources coming up to support real estate. But to me, I think the bigger one is around a comment that was made around the extent to which currency depreciation actually feeds into the price of houses, such that if the currency depreciates, then that reflects an increase in prices. And that speaks more to the fact that, our domestic construction industry, which by definition, housing is in economics classified as an untradable, is linked to external inputs, be they steel or whichever input that is happening there. And therefore, when you have a local construction industry that has very strong linkages in terms of the chain to external markets, then you start seeing a situation where the currency becomes a factor insofar as the price of houses is concerned. And therefore, when you start looking at the dynamics of real estate, then it's a it's as well, you start looking at how is the real estate integrated to the production of inputs to the housing sector or the real estate sector from the domestic industrial base as opposed to imports that come into the real estate. And that speaks now to issues around, almost importing everything from furniture to curtains to all that goes into real estate, and therefore making it vulnerable to currency shocks. I think that's something that is worth noting as you are pondering around the foreign capital participation in the local market.
Thank you so much, Jared, for your comments. I'm not too sure if we have any other questions. Anybody else with a question for the panelists before we give an opportunity for final remarks?
Winnie?
Yes, Sakina.
Hi, sorry, if I could just answer the Rawlings question.
Yes.
Just based on sort of actual data, out of the 12 developments that we are handling, only one of them has foreign capital participation. So in terms of using our developers as a bit of a sample, I would say we're seeing 10% foreign capital participation.
Thank you so much, Sakina. So seems like we do not have any other questions from the participants. So we will welcome the panelists to give their final remarks. Oh, Rawlings, please go ahead. You can unmute and ask.
Yeah. Yeah.
Rawlings? All right, Rawlings, we seem to have lost Rawlings. He has his hand raised. So we'll just proceed to ask the panelists to make their closing remarks, and we'll start with Ms. Sakina.
Thank you, Winnie. I think what I would say about COVID or the global pandemic is that I think everyone was able to learn some very valuable lessons within the real estate sector. Any inefficiencies that were currently that were previously sort of probably not such a big highlight were very highlighted during this time, and I think people who want to responsibly carry on development in this country should use those lessons to create more robust structures so that we are protecting investor capital, and not only protecting it, but also making sure that real estate is a great wealth creator for people within Kenya, just because it is the safest asset class at the moment, and I think that having a robust sector will maintain that integrity to the sector at large. So that's what I would say.
Thank you so much, Sakina. Ms. Elizabeth?
I think for me, the key thing is that there is still a lot of opportunities in the real estate sector when you think about the amount of housing that is still required and people to live in a decent in a decent place. So the right policies will attract the right capital, because I believe there is no shortage of capital. The only issue is how do you bring in the capital, and then how do you ensure that the capital is actually protected, and that will help in terms of growing at least speaking to the housing deficit. So I feel like there's a lot of discussion that needs to go on between the government and the private sector in terms of the affordable, maybe something like the affordable housing agenda, and just making sure that the incentives that are given, as Jared has said, they are actually been tapped into and they make sense for the private sector, because that is where the opportunity is. So thank you so much.
Thank you so much, Liz. Jared?
Yeah, thank you, Winnie. I think to me also is to echo both Liz and uncertainty, given the fact that there's a lot of opportunity in real estate and construction generally. And I think the fact that there are shortages simply means that, if you align the incentives properly, both from the commercial and from the public, I think then you start seeing resources being appropriately allocated to this critical component. I think the second thing I'll say is that we probably have to start seeing the sector from the lens of growth, yes, but is it growth that is really taking it to its optimal, or is it really taking advantage of its full potential? And that's why I think we need to start seeing the extent to which we can enhance the real estate's essence of being leveraged. Being under leveraged may be seen, but I think it makes sense for real estate to take advantage of the advancement that the financial sector have done, so that it's really propelled in a manner that makes it grow. And I think my final one is, and unfortunately it has not featured whatsoever in our discussion, developing real estate in a manner that ascribes to the green principles. Talk about real estate from a sustainability standpoint, meaning we are developing real estate in a manner that does not compromise on the ecological aspects. The energy usage is in conformity with the sustainability aspirations of the economy, and therefore feeding into the broader aspiration of being a green and sustainable economy. And if it's something that we can embed as we develop the real estate, then that will be very important in my view. So thank you very much.
Thank you so much, Jared, for those remarks, and to Liz and Sakina for making time today to be part of this conversation and to just give us insights on what the real estate looks like even in the wake of this pandemic. And we are glad that it's not as bad as we may assume it to be, and with the reopening of the economy, things are actually looking up, and we will be witnessing some growth in that sector. So having said that, we would also like to appreciate our participants this morning for creating time and sparing their time to be part of this conversation. And yes, I can see someone asking if we will be sharing the slides. Yes, the slides are available on our website. If you just go to our website, you will find the 2 slides that we have been sharing today. And also to remind you that the Institute of Economic Affairs is a membership organization, and on our website you will find the membership forms that you may need to fill and all the membership details that you may require even as you make a decision to join. And also be on the lookout. We are still holding a series of webinars to discuss different issues globally and locally. So please be on the lookout for the future webinars that we will be holding. And on behalf of the IEA and our CEO, Mr. Kwame Owino, who was part of this meeting, we would really like to say a big thank you for making time to be in this conversation and for joining us this morning. So we wish you all a lovely afternoon and do enjoy the rest of your day. And and thank you so much for being here today. So bye guys. Thank you so much.
Thank you.
Thanks, Winnie.
Winnie, please remain behind.
All right.